Section 3.2 Aggregate Supply. The aggregate supply curve shows the relationship between domestic output and price level. As with the aggregate demand curve, we are talking about a particular economy and the output of this economy. Unlike the aggregate demand curve, however, supply depends on the time frame that we are talking about. If you think about the different firms or businesses in a given economy, obviously the output will depend on price level, and also the change in output will depend on the time frame that we are talking about. If we talk about the very short run, then companies increase or decrease output without changing prices. In the short run, this might be, say, months or quarters, some costs are sticky, so businesses increase output when prices increase. And that is shown over here. This is the short-run aggregate supply curve. And to understand this, think of yourself as a business owner. Let's say that you sell widgets and the price of widgets is up. So you can sell this at a higher price. In the short run though, most of your costs are sticky. In other words, let's say your costs include wages and rent and so on. And let's say that in the short run, these costs do not change much. If your cost structure is roughly the same, but the price of the product that you sell is higher, that's a good sign. So if the price goes up, then the quantity that you supply will increase. And you can think of this concept as applying across all firms in a given economy, and you see why the short-run aggregate supply curve is shaped like this. What about the long-run aggregate supply? Notice that the long-run aggregate supply is at a certain level, and this long-run aggregate supply does not depend on price level. The reason is that in the long run, wages and other costs adjust. So if prices are up in the short run, wages might be sticky, which means in the short run, wages don't change so much. But if prices are up, then eventually the cost of labor and other costs will also go up. And that's what we mean when we say expectations adjust. So if prices are up by 10% and eventually in the long run, all your costs are also up by 10%. And here again, you imagine yourself as the business owner. If prices are up by 10% and your costs are up by 10%, then in real terms, you are back to where you started. So in real terms, you end up where you started. So here is our journey very briefly. When prices of your product went up, initially you increased supply. So we moved along the short-run aggregate supply curve, but eventually as the costs went up by the same percentage, you come back to your original quantity. And therefore the long-run aggregate supply is a vertical line at a given level of output. There is also the concept of very long run. In the very long run, the long run aggregate supply curve will shift to the right. As the productive capacity of an economy increases, this particular curve shifts to the right, and that will be discussed in section 4. Here I also want to draw a distinction between the terms short run and long run as used here in macroeconomics and short run and long run as used in microeconomics. When we say short run in microeconomics, we mean that some factors of production are fixed and some are variable. So in micro, simplistically, we say that in the short run, labor is variable, but capital is fixed. Notice that the distinction between short run and long run is different when we talk about macroeconomics. When we say short run here, we say that wages or some costs are sticky, which means they don't change in the short run, but all costs, which includes wages, change or adjust in the long run. Make sure you understand that distinction between micro and macroeconomics. Here is a quick question for you now. What is the relationship between wages and the slope of the short-run aggregate supply curve? Let me make this a little more concrete. Let's say that you have two scenarios, A and B. In scenario A, wages are sticky, and wages being sticky means that they don't change very easily. The other scenario is that wages are not sticky. If wages are sticky and the price goes up by a certain amount, what would you as a business owner do? Would you like this or not? You would actually like this. Why? Because wages sticky means that your cost is not going up too much. So if the product that you sell goes up in price, then you will increase your output quite a lot. So our short-run aggregate supply curve will have a slope that is not very high, because a certain level of price increase causes the output to go up by a substantial amount. On the other hand, if you have a situation where wages are not sticky, this means that wages adjust quickly. When the price level goes up, wages also go up quite easily. If that is the case, then an increase in price will result only in a small increase in quantity. So in that situation, our short-run aggregate supply will look a lot like a long-run aggregate supply. In other words, the slope of the short-run aggregate supply will be much greater. So that is the relationship. If I were to summarize what has been stated here, the relationship is that when wages are sticky, then the slope of the short-run aggregate supply is relatively low. If wages are not sticky, then the slope of the short-run aggregate supply is relatively high. Coming now to shifts in aggregate demand and aggregate supply. Before we go into the actual shifts, I want to set the context. On this particular picture, I am showing you the aggregate demand curve, the long-run aggregate supply, and the short-run aggregate supply. Most of what we will talk about over the next few slides will have to do with the interaction of these curves. In the scenario that you are looking at here, the three curves all pass through the same point, and the output level shown over here is important. This output level is called the long-run equilibrium level of output. This is also called the natural level of output. Output, as you will see shortly, is closely related to employment. When we are at the natural level of output, we say that we are at full employment. And another term that is used is the natural rate of unemployment. The point to remember here is that full employment does not mean 100% employment. This means that we have some natural level of unemployment. And by natural level of unemployment, we mean that there is a normal scenario where people are between jobs, and the way we can look at it is that the percentage of the workforce that is looking for jobs is roughly equal to the percentage of vacancies in the economy. You need to remember this terminology because it is used quite often in the macroeconomic context. Over the next few slides, we will talk about the interaction of these curves, and in doing so, we will answer these important questions. What causes an economy to expand and contract? what causes changes in price level and unemployment, what determines an economy's rate of sustainable growth. You might wonder why this is important. And if you think about it, GDP growth, which is the growth in output, impacts corporate profits, which has a tremendous impact on stock prices. So if you are an equity analyst investing in a particular region, having a sense for the GDP growth rate for that particular region is extremely important. If you are a fixed income securities analyst, then you need to recognize the fact that inflation is built into bond yields. So changes in inflation will impact bond yields, which will impact bond prices. So this material is important. Now let's take a look at the aggregate demand curve and what are the factors which would cause the aggregate demand curve to shift. There is a fair amount of material on this in the curriculum, but I think the information that you need to know is captured very well in Exhibit 18, and the table that I'm showing you here is based on this exhibit. So we have a given aggregate demand curve. What happens if stock prices increase? The answer is that the aggregate demand curve will shift to the right, and the right shift means that the aggregate demand curve moves like this. The reason is higher consumption. This effect is also called the wealth effect. People save money, and with the savings they might buy stocks. If the value of stocks goes up, people feel richer, wealthier, and since people feel wealthier, they tend to consume more. Consumption goes up, aggregate demand goes up. If you remember the expression for overall expenditure, that expression is C plus investments. So consumption, investments, government spending, and net exports. What we are saying here is that the wealth effect causes C to go up, and hence the aggregate demand will shift to the right. The same happens with housing prices. If housing prices go up, people who own houses feel richer, so the aggregate demand curve will shift to the right, and again, due to that wealth effect, people will feel richer and consume more. Now I want you to think about these other items and fill them in before you look at the solution. Here is what you should come up with, and I'll just walk you through this very fast. Consumer confidence. If this is up, people are confident about maybe earning more in the future. They will therefore spend more, consumption is up, and aggregate demand moves to the right. What you need to have at the back of your mind is that overall demand or aggregate demand is reflected by this equation: consumption plus investment plus government spending plus net exports. If business confidence is up, then again the aggregate demand shifts to the right, because when businesses have a positive outlook, investments will be up. If investments go up, then the overall aggregate demand goes up.
With respect to capacity utilization, we can say that when companies have excess capacity, they avoid investments in new property, plant, and equipment. However, when they are operating near full capacity, they tend to increase investment spending in order to increase production.
When government spending increases, that's the G component in this expression. Government spending goes up, so aggregate demand goes up. When taxes increase, then the aggregate demand curve shifts to the left. There is a decrease because higher taxes means lower disposable income. Therefore, consumption and investment both go down. Bank reserves. If bank reserves are higher, that means there is more money. More money means interest rates are lower and investment is higher. Exchange rate, when exchange rates are higher, this means that our domestic currency is becoming stronger, and that is explicitly mentioned in this segment of the table. So if our domestic currency is stronger, then exports go down, imports go up. So our net exports are down, which means that aggregate demand moves to the left. If there is global growth, that means the rest of the world's economy is becoming larger, exports go up. So this part of the expression x minus m is higher and aggregate demand is higher. There are aspects of this table which will be covered in detail later. For example, government spending and taxes has to do with fiscal policy, and there is a reading later which covers fiscal policy and monetary policy. Monetary policy impacts bank reserves and exchange rates. So for now, just take my word for this material. In the next two readings, we will get a better sense for these variables or these factors. Please also go over examples 7 and 8. They illustrate the concepts that we are talking about. There is actually one more point I want to highlight here before we talk about shifts in aggregate supply. When aggregate demand shifts to the right, so let's say we move from AD1 to AD2, in the very short run, output goes up and price level stays the same. But in the short run, prices go up, so then we move from point A to point B. Notice that from A to B, the price level is increasing and quantity then comes down a little bit from A to B. And eventually, as wages and other costs also increase in line with the price level, we end up here at point C. Notice that at point C, all that has happened is that there has been an increase in the price level. The output is back at where we started. We now come to shifts in aggregate supply. And notice that we need to think both about shifts in the short run aggregate supply and shifts in the long run aggregate supply. And just to refresh your memory, we have output on the x-axis, price level on the y-axis, and the short run aggregate supply looks like this. The long run aggregate supply is a vertical line. There are some factors which are shown in bold over here, which cause both the long run aggregate supply and the short run aggregate supply to shift. There are other factors shown over here which only impact the short run aggregate supply. So let's go over these factors. Supply of labor. When labor goes up, labor is producing output. So if we have more labor, then more output can be produced. That shifts both curves to the right. The reason is fairly obvious. Supply of natural resources. This will also shift both curves to the right. Here we are talking about increases. Clearly, if there is more natural resource, then the output of a given economy will increase. Supply of human capital. So if people are smarter, working better, then both curves will shift to the right. If the supply of physical capital increases, then again both curves shift to the right because our resource base is up. If we have better technology, we are more productive, then both curves shift to the right because the efficiency is more. Then we come to these factors which only impact the short run aggregate supply. If nominal wages increase, then the short run aggregate supply will shift to the left. Nominal wages going up means that the cost is higher, therefore companies or firms will scale back. That's why the short-run aggregate supply shifts to the left. The same reason holds true with other inputs. So let's say other factors become more expensive, cost is higher, so the curve shifts to the left. Expectation of future prices. This is a little complicated, but here is how you can think about it. If firms expect future prices to go up, then they will produce more or supply more to take advantage of those higher prices. So we can say that the curve will shift to the right. If business taxes are up, that increases the cost to a firm, so the curve will shift left. If subsidies are up, that actually lowers the overall cost, so the curve shifts to the right. Exchange rate is also a little tricky. We need to make some assumptions here. If we are in a country where raw material is imported and represents a major cost, then if the country's currency becomes stronger, then the cost of raw materials will come down and the supply curve will shift to the right. In terms of the long run aggregate supply, for all these items, there is no impact. Now I want you to do examples 9, 10, and 11, which illustrate the concepts we have spoken about over here. And the material that we see here is based on Exhibit 20 in the curriculum. Section 3.4, Equilibrium GDP and Prices. Short-run macroeconomic equilibrium may occur at a level above or below full employment. There are 4 possible scenarios which we will talk about, but first I want to make sure you understand 2 important terms over here: macroeconomic equilibrium and full employment. Short-run macroeconomic equilibrium is the point where aggregate demand and short-run aggregate supply intersect. So a price level and an output where these two curves intersect would be called the short-run macroeconomic equilibrium. When we talk about the full employment level, we are talking about the long-run aggregate supply curve, and we are saying that the level of output associated with the long-run aggregate supply curve is also the point where we have full employment. So if we have full employment, then we are at the natural level of output, or we can also say that we are at the natural level of unemployment. And this is something that we have spoken about earlier. If we are to the left of this point, that means that we are below full employment and unemployment is higher than the natural rate of unemployment. Now let's look at the 4 situations. Here is the first one: long-run macroeconomic equilibrium. We say we are at long-run macroeconomic equilibrium if the short-run equilibrium point, which is given by the intersection of aggregate demand and short-run aggregate supply, if that point is on the long-run aggregate supply curve, then we can say that we are at long-run macroeconomic equilibrium. Notice, as I've said several times, this is the natural level of output. When we are here, then the economy is at full employment, or we can say that unemployment is at its natural rate. The second situation is a recessionary gap. Let's say that for some reason aggregate demand shifts to the left or shifts down, as shown over here. We go from AD1 to AD2. Notice that if we were originally at this point over here, let's say that this point is Y1, now we will end up over here. So the short run equilibrium, which is given by the intersection of the aggregate demand and the short run aggregate supply curves, is now at this point over here. The price level has come down relative to where it was before, but the output has also come down. So price going down is a good thing, but output coming down is not good because unemployment has gone up, or we can say that we are below the natural level of output, which is a negative. And this gap or this difference is called a recessionary gap because we are below the potential level of output, which is given by the long run aggregate supply curve. Next situation, inflationary gap. This happens if the aggregate demand curve shifts to the right. In this particular scenario, if we go from AD1 to AD2, look at what is happening to the output. Initially, the output was here at Y1, and let's say the price level was at P1. The new short-run equilibrium is to the right of Y1. So now Y2 is to the right. And this is called an inflationary gap because this is putting upward pressure on price levels. Initially, as we go from point A to point B, price levels are increasing. That's a bad thing, but output is going up. So we are actually above full employment. What this means is that people are now working extra hard. Perhaps they are working overtime, which is why even though this is our natural level of output, we are producing, our economy is producing a little bit above that level. If this is the case, then eventually people will demand more money for working extra hard. So wages will go up, prices will go up, and we will end up back over here because when costs go up, then the short run aggregate supply curve will eventually shift to the left as we have discussed before, and we will end up at this point. Notice that effectively prices will have gone up, but the level of output will return to Y1. And you can see why this gap is called an inflationary gap. It drives inflation. And finally, we have a situation called stagflation. What is happening here is that for some reason, the short run aggregate supply is shifting to the left. Let's say that costs go up suddenly and unexpectedly. So the short run aggregate supply shifts to the left. Here we'll move from this point to this point in the short run where two bad things are happening. Output is down, which means unemployment is above or higher than the natural level of unemployment, and price levels also go up. So this situation is called stagflation. Here is some work for you to do based on what we have spoken about, and this is based on Exhibit 26 in the curriculum. You need to draw the aggregate supply and aggregate demand curves and show what happens if we have an increase in aggregate supply and an increase in aggregate demand. What will be the effect on the real GDP? This is the x-axis, and the effect on aggregate price level, which is the y-axis. If you've understood the discussion we just had, then this should be easy. And here is what you should come up with. If you had trouble coming up with these answers, then you need to listen to the relevant segment of the video again. And after that, make sure you go over examples 12, 13, and 14.